Okay, so in this particular topic here of financial instruments, we're going to basically look on a number of things. One, we're going to define what is a financial instrument. We're going to define what a financial instrument is. And then from there, we also look on the definition of other terms which relate to financial instruments. Specifically, you're going to look on definition of something called the financial asset and financial liabilities, And then from there, we're also going to look on something called the recognition and the recognition of financial instruments. And then from there, we're also going to look on the classification of financial asset and financial liabilities and also the accounting treatment, or basically how the financial asset, or basically how different types of financial asset and financial liabilities are accounted for in the company's books of account. So therefore, by the end of the day, or once we are through with this topic, these are a number of things you should be able to know. You should be able to tell what a financial instrument is. You should be able to define what is a financial asset, what is a financial liability, and also when the company should recognize a financial instrument in its books of account, and something called recognition. The recognition is a process through which now a company will have to remove from its books of account a financial asset or a financial liability which was previously recognized. And also from there, we look on the various categories of financial asset, how financial assets are classified in accordance with the IFRS 9, and also the classification of financial liabilities, and also how we account for various categories of financial asset and financial liability. So therefore, those are basically some of things you should be able to know by the end of this topic. So we start with the definition of a financial instrument. And a financial instrument, according to this standard here, IFRS 9. And I think before we define this, maybe the first important thing I can mention here is that IFRS 9, this is a new standard, which was issued by this body known as the International Accounting Standard Board. Because when we talk about the International Accounting Standard Board, this is the body which is in charge of developing and issuing accounting standards. So the accounting standards which are currently issued by this body, they are known as IFRS, International Financial Reporting Standard. Now, this particular standard, IFRS 9, is a new standard which was issued to replace a previous standard which was known as IS 39. IS 39, that is International Accounting Standard number 39. This standard has been scrapped, it has been done away with, and basically replaced with the IFRS 9. So therefore, currently, in terms of how financial asset, financial liabilities are accounted for, that is governed by IFRS 9. But previously, I think this standard was issued even not long, around 2016. Previously, how financial asset, financial liabilities were accounted for, that was done in accordance with IS 39. But I've said that standard has been done away with, has been scrapped, and basically replaced with the IFRS 9. Now, coming back to our definition here, when talk about a financial instrument, basically these are those particular instruments generally which are issued by the company whenever the company is to raise capital. Like generally what we know is that if we have a company and that company wants to to raise capital, that company can either issue shares, or that company can issue things like debentures, can issue things like bonds and so on. So those instruments which are issued by the company to raise capital, generally we refer to them as financial instrument. But in terms of how financial instrument is defined under IFRS 9, this is defined as a contract, or we say that financial instrument is a contract, which give rise to a financial asset, to one entity, and a financial liability, or equity to another entity, to another entity. So therefore, that is the definition of what referred as a financial instrument. Is a contract which give rise to a financial asset to one entity, or and a financial liability or equity to another entity, Now remember, what you have said is that financial instrument generally are things like shares, things like what? Debentures and so on. So maybe let's assume here we have a company, assuming we have company A, and this company, our company A, has issued, for example, ordinary shares, or maybe this company has issued some debentures. And some of the shares or debentures issued by this company have been issued to company B. What does that mean? It means that these two companies here have entered into a contract. Generally, if today you buy some shares in a company, or you buy some debentures issued by a company, and then we say that you have entered into a contract with that company. And in this contract, which is entered into between these two companies, this contract for the issue of shares or debentures, then we say that it gives rise to financial asset to one of the company, and a financial liability or equity to the other entity. Like in this case, what we know is that if this company, for instance, has issued shares, our company here has issued ordinary shares, we know that ordinary share capital, basically this company here, that is company A, raises a capital which is known as ordinary share capital. Now, ordinary share capital, we know that it is part of equity, because when we talk about equity here, equity comprises of ordinary share capital and reserve. So therefore, once this company has issued ordinary shares, it raises ordinary share capital, which will be part of equity. On the other hand, if this company issues debentures, then we say that this company has an obligation to pay interest. If, for example, you buy some debentures in a company, or even things like bonds, you have the right to be paid interest. Now, the company which has issued those bonds or debentures, on the other hand, we say it has an obligation to pay cash, which will be in form of interest and so on. So therefore, once this company has issued debentures, then we can say that this company has an obligation, a financial obligation to pay cash, of which this cash will be in form of interest and also in form of principal amount. Now, when we talk about an obligation to pay cash, an obligation to pay cash is a form of liability, and specifically we say that that is a financial liability. That is a financial what? Liability. So basically what that means is that once this company has issued debentures or anything, things like bonds, then that gives rise to a financial liability as far as company A is concerned, because that company, we are saying, it has an obligation to pay what? Cash, which is in form of interest interest, and the principal amount. What is principal amount? Principal amount is basically the amount which is payable by the company at the end of the life of the debentures. Like, I hope you know something to do with these securities which are issued by the government, treasury bills, treasury bonds, and maybe you have, for example, invested in them. Those particular instruments issued by the government, whenever the government is to do what Ifrs is domestic borrowing, is to borrow from the members of the public. Once, for example, the government has issued treasury bonds, or you buy treasury bonds, you may be told that those treasury bonds, they have a life of 3 years. What does that mean? It means that once you have invested in these treasury bonds, the government is supposed to pay you interest, of which in most of the cases, the interest here is payable semi-annually. And then at the end of the 3rd year, you'll be given back the amount of money you had invested. If you had bought treasury bonds of like 500,000, at the end of the 3rd year, you'll be given back your 500,000. So meaning that 500,000 which will be given to you at the end of the 3rd year, this is the principal amount you had invested. So therefore, you can see, as a result of having invested in treasury bonds, you'll be having the right to receive interest and a principal amount. So therefore, principal amount is always important to remember or to know. It is the amount which is payable at the end of the, or at the maturity date. Like in this case, treasury bonds having 3 years, having a life of 3 years. The end of the 3rd year is said to be the maturity date. That is the date the government is supposed to do what? To refund back the principal amount. So therefore, once this company has issued ordinary shares, we have said that that give rise to equity. And then once it has issued debentures, it gives rise to a financial what? Liability. Then on the other hand, this company which has bought now the shares or debentures issued by company B, by company A, this company will be deemed to have invested. Now, anytime you make an investment in shares, anytime you make an investment in treasury bills or any other form of debt instrument, then to you that investment is an asset. So therefore, this company which has invested in shares or debentures, or that investment is a form of an asset, and specifically we say that that investment in shares, investment in debenture, in debt instrument, that is a form of a financial asset. Is a form of a financial what? Asset. And therefore, coming back to our definition here, remember what you have said. A financial instrument is a contract which gives rise to a financial asset to one of the entity, and a financial liability or equity to the other entity. We have said that this is a contract for the issue of shares or other form of debt instrument. Now, in this contract between company A and company B, you can see as a result of company B having invested in shares or in debentures or shares issued by company A, then that gives rise to a financial asset to company B. And then as a result of this company having issued shares, that gives rise to equity. As a result of this company having issued debentures, that gives rise to what? To a financial liability. And that's why I've said generally, anytime you hear the word instrument, that is financial instrument, what should come into your mind is that we are talking of things like shares. We are talking of things like what? Like debentures, like bonds, and so on. So those particular contracts involving issue of shares, involving issue of debentures and bonds, they are good examples of financial what? Instrument. And also what you have said is that here, other than being in a position to define a financial instrument here, you should also be able to define what is a financial asset and what is a financial liability. And then first of all, we have defined a financial liability, and basically you have said that this is an obligation to pay cash. Once a company has issued debentures, or maybe the company has issued some bonds, then that company has an obligation to pay what? Cash, which is in form of interest, which is in form of what? A principal amount. But on the other hand, we'll talk about a financial asset, because you have said once, for example, as an individual, you have invested in shares, you have invested in various debt instruments. To you, that investment in shares and debt instrument is a financial asset. So a financial asset is basically something like cash, or in other terms, you can say that a financial asset is a contractual right to receive cash. If you have invested in shares, we know that you have the right to receive dividends from the company whereby you have bought shares. If you have invested in something like government securities, treasury bills, treasury bonds, you have the right to receive interest and also the principal amount. So that contractual right, or that right, you derive from a contract to receive cash, which is in form of interest, which is in form of a dividend, then that contractual right to receive cash is a form of a financial asset. So therefore, in that case, we have managed to define three terms: financial instrument, financial asset, and also financial liabilities. Then from there, we can also look on something called the recognition and the recognition of financial instruments. We start by looking on what we refer to as recognition of financial instruments. Recognition of a financial instrument. Now, what do you mean by recognition of financial instrument? Recognition of a financial instrument, basically this is a process through which now a company will recognize, will record financial instrument in its books of accounts, Now, IFRS 9 requires that whenever the company, for example, has issued some shares, whenever the company has issued some debt instrument, or even a company has invested in shares or in debt instrument, the company should go ahead and recognize such financial instrument in its books of account whenever the company becomes a party to such a contractual relationship, even if the company has not paid the shares, has not paid cash for the shares acquired, or basically the debentures which have been issued. So therefore, in this case, we can say that financial instrument are recognized. Recognized is to do what? Is to record. Are recognized, or basically are recorded in the company's books of accounts. In the company's books of accounts when the entity becomes a party to the contract, When the company becomes what? A party to the contract, and then it should go ahead and recognize, or basically record such shares or debentures in its books of accounts. Like basically what that means is that if we are told that this company A, has issued shares or even has issued debentures, the date the shares or debentures are issued, even if the company has not received cash, the company should go ahead and record the shares or debentures in its books of account, even if the cash has not been received. The same case, once this company has bought the shares or debentures issued by company A, even if company B has not paid for the shares or debentures acquired, then we say that it has already become a party to the contract. It should go ahead and record those shares or those debentures acquired or basically issued in its books of account. In its books of what? Of account. Very, very important. Then from there we have something called derecognition. Derecognition of a financial instrument. What do you mean by derecognition? The recognition of financial instrument is a process through which a financial instrument which were previously or which have already been recorded in the company's books of account will be removed from the company's books of account. Or in other terms, we can say that this is a process through which now the company will do what? will stop accounting for a financial instrument in its books of accounts. And in this case here, we are going to look on the recognition of both financial asset and also financial liability. I think we can start with the financial asset, and we say that, okay, before we do that, I think first of all, we can define what the recognition is. That is important. We can say that the recognition is the removal, of previously recognized financial instruments from companies' books of accounts, from companies' books of what? Of account. Removal of previously recognized financial instrument from the company's books of account. Because remember what you have said here is that once the company, for example, has acquired shares, or maybe the company has invested in shares or in any other form of a debt instrument, then that investment in shares, that investment in debt instrument must be recorded in the company's books of what? Of account. And therefore, we are saying the recognition now is the removal, or basically the process through which now the company will stop accounting for a financial instrument in its books of accounts. So here I've said that we're going to look on the recognition of financial asset and also financial liabilities. And therefore we can say one, financial asset should be derecognized, should be derecognized when basically we have two circumstances under which a financial asset should be derecognized, or the company should stop accounting for financial assets in its books of accounts. Number one is when the company transfers all the risk and rewards associated with a financial asset. So therefore, one we can say is when the entity transfers all risks and rewards associated with a financial asset. What do we mean by the company transferring the risks and reward associated with a financial asset? This whereby the company has invested in shares, but the company sell those shares or sell those particular debentures. Remember, or like maybe let's assume here we have company X, and you're told that this company has invested in shares, or maybe it has invested in a other form of debt instrument. In this case, when we talk about debt instrument, you're talking of things like debentures and so on. So therefore, that company has invested in shares, has invested in debt instruments. Generally, what we know is that anytime you make an investment, that investment is associated with some risks. And also, as a result of making that investment, then you are entitled to various forms of rewards. For example, once you have invested in shares, you are entitled to receive some dividend. Once you have invested in debt instrument, you are entitled to receive some interest. That return, which you are entitled to, we can say is a reward. Is the reward you are entitled to anytime you make an investment, that investment has some risk, has some what? Risk. So therefore, whenever this company transfer this risk and rewards, then the company should recognize. And basically, in this case, we have said to transfer is to do what? Is to sell. Is to do what? To sell. This company has sold all the shares or debt instrument it had previously acquired. So in such a case, we say that that company has transferred all the risk and rewards associated with the financial asset to another entity or maybe to another party. So therefore, it is obvious that that company cannot continue accounting for those shares cannot continue accounting for its investment in shares or debentures because the company has transferred all the risk and rewards associated with what? With those shares. Two is that a company should recognize a financial asset whenever the company right to receive cash has come to an end. Number two, when the entity's right to receive cash expires or basically it has come to an end. The entity's right to receive cash has done what? Has expired. What do we mean by this? When talk about the entity's right to receive cash expiring or basically coming to an end, this is whereby, for example, you may have invested, for example, in those securities issued by the government. Whenever the government is to do domestic borrowing, for example, we assume we have company X, and this company had invested in some government securities, e.g. treasury bonds, and these treasury bonds which were issued, they had a life for 5 years. A life for 5 what? Yes. Remember what you have said is that this company now here will be entitled to receive interest for the next 5 years, and then at the end of the 5th year, it will be given back the principal amount it had invested. So basically what that means is that at the end of the 5th year, the right to receive cash by this company will come to an end. The company will have been paid interest for the 5 years, and the company at the end of the 5th year will be given back the principal amount. That company cannot continue receiving cash. So therefore, the right to receive cash will be deemed to have what? Expired. And therefore, it is obvious that that company, because it has been given back the amount of money it had invested, it cannot continue accounting for those particular what? Financial asset in its books of account. So therefore, we have those two circumstances under which now a company should do what? Should recognize financial asset. So therefore, we have those two circumstances under which financial asset should be recognized. Then from there, we can look on the recognition of financial liability. And we can say here, that financial liability is recognized when the obligation to pay cash expires or is extinguished So what do you mean by this? So financial liability, remember we say that is where the company has an obligation to do what? To pay cash. Like maybe we assume we have a company here, company X, and this company has issued some debentures. These debentures, let's assume that they have a life of 3 years. they have a life of 3 years. What does that mean? It means that this company which has issued those debentures will be required to pay interest for the next 3 years, and then at the end of the 3rd year, it must pay back the principal amount. The principal amount. That means that at the end of the 3rd year, then the obligation to pay cash will expire or is extinguished. To extinguish something is to bring something to an end, to extinguish the fire, to put off the fire, and so on. So therefore, at the end of the 3rd year, the obligation of the company to do what? To pay cash will be extinguished. Basically, what that means is that the company should then proceed and do what? Derecognize that financial liability or those particular debt instrument in his books of account. So therefore, it is important there for you to note there the circumstances under which a financial asset is derecognized, and also the circumstances under which a financial asset will also need to be derecognized. Yes, so there is a question which I've seen which was asking on that. I don't know whether I can be able to quickly retrieve that question. Let me see whether I can be able to quickly retrieve that question about recognition and the recognition of financial asset and liabilities. Yes, so we have that question here. We have that question here. So the question, let me check the year and the sitting. Okay, if I'm not wrong, I think it's a question for November 2018. Question number 3A. It reads, International Financial Reporting Standard number 9, which deals with the financial instrument, establishes principles of derecognizing financial asset and financial liabilities. And in that case, you're told derecognition is the removal of a previously recognized financial instrument from the entity's statement of financial possession. So we are required, with reference to the principles of IFRS 9, describe the criteria for the recognition of financial asset and financial liability of an entity. So, and that the question was having 6 months. So what basically you're required to do is you explain the principles, or basically not the principles, but rather the criteria for the company or for the recognizing a financial liability. Remember, you have said the recognition is that removal of a previously, these should be previously recognized, previously recognized financial instrument from the entity's books of account or a statement of financial possession. So in this case, we have said we have 2 criteria of recognizing a financial asset: when the entity transfers all the risk and rewards associated with the financial asset, and 2, when the entity's right to receive cash expires. So those are the 2 criteria. So you're supposed to give the 2. I think you get 2 marks for each. Any 2 at 2 marks there. 2 marks, 2 marks. And also you say that a financial liability will be recognized when the obligation to pay cash is extinguished or expires, and still there you get you get 2 marks. So total there, you get how many marks? You get 6. Yes. So that is it. That what was required as far as that question is concerned. And from there, I think we can proceed and look on something else. We proceed and look on something else, still in respect to financial instruments, and that is something we refer to as compound financial instruments. Compound financial instruments. Compound financial instruments. Now, what is a compound, or what are compound financial instruments? Now, compound financial instrument basically refers to those financial instruments which contains both the equity component and the liability component. So I've said that these are those financial instruments containing both the equity and liability component. We can say that these are financial instruments containing both equity and liability component. And liability what? Component and liability component. Financial instrument containing equity and liability component. Now, what are good examples of this? What are good examples of this? A good example of a compound financial instrument is what you refer as the convertible securities. Examples include convertible securities. So in this case, when we talk about the convertible securities, we are talking of things like the convertible debentures. We are talking of things like the convertible bonds, etc. So these are good examples of compound financial instrument. So why do we say that these particular convertible securities or convertible instrument are good examples of compound financial instrument? Let's assume that we have a company here, and that company has issued, company X here has issued, for example, some debentures which are convertible debentures. Now, as a result of having issued these particular debentures, this company has an obligation to pay, cash. So the cash now to be paid by our company here, remember you have said that it will be in form of interest and the principal amount. Now, what you have said is that this obligation to pay cash is a form of a financial liability. And therefore you can say that this company, as a result of having issued debentures, that give rise to a financial liability as far as that company is concerned. Two, as a result of that company having issued these debentures, and that's why you can see they are known as convertible debentures, then we say that they confer or they grant their holders an option to convert them into ordinary shares. Anytime you buy debentures which are known as convertible debentures, the reason why they are known as convertible is because you can be able to convert them into ordinary shares of the company at a given rate of exchange. So once you convert them into ordinary shares of the company, then it automatically means that this company will have to issue you with shares. And once the company has issued ordinary shares, automatically it gives rise to equity. So therefore, other than these convertible debentures requiring this company to pay in cash, we also say that it grants. To grant is to give. Grant the holders an option to convert them. An option to convert them to to ordinary shares, to ordinary shares of the company. To ordinary shares of the company. Basically, what that means is that if you have bought now the convertible debentures of the company, you have the right to receive shares of that company. That right to receive the shares of a company, that right itself is a form of an equity, is a form of equity. That right to receive, if you have a right to receive the ordinary shares of the company, that right itself we refer to it as equity. Because equity generally by definition we say is the residue interest, is the interest in the asset of the company. If you acquire shares of the company, you become a part of the owners of that company. So therefore, that right, if you have the right to receive ordinary shares, is a form of equity. So therefore, you can see that as a result of the company having issued any security which is convertible in nature, like convertible debentures and so on, then it gives rise to both financial liability and equity. Therefore, coming back to a definition here, you can see that we have said that a compound financial instrument is basically a financial instrument which do what? Give rise to a is a financial instrument which contains both the equity component and the liability what? Component. And the liability component, very, very important. A compound financial instrument is a financial instrument which contain equity and liability component. Good examples of that are convertible securities or convertible instrument, e.g. convertible debentures, convertible bonds, and so on. The reason why we say they contain both the liability and equity component is because they confer the holders, they give the holders an option to convert them into ordinary shares, and two, they impose an obligation. They impose an obligation to the issuer to do what? To pay cash. To pay what? To pay cash. Now, how should this compound financial instrument be accounted for? Now, they are accounted for in accordance with a standard which is known as, or a standard that is IAS 32. IAS 32 basically governs how this compound financial instrument should be accounted for. International Accounting Standard number 32. IAS 32 requires a compound financial instrument, or we can say that requires an entity to split the two components. So which are those two components? We are talking of now the equity component and also the liability component. So the two components should be splitted. Should be what? Should be splitted. Now, for the company to be able to split the two components, we have two steps which are followed. For the company to do that. One, the company should determine, or basically for us to be able to split the two components, one, we need first of all to compute the liability component. Step number one, compute the liability component. Remember, we have said that the liability component arises from the obligation of the company to pay cash. And therefore, how do we compute this liability component? This liability component is computed by discounting what the company is required to pay. Like maybe let's assume that we have told company X here has issued these particular debentures, and maybe the debentures have a life of 3 years. Basically, what that means is that our company here, that is company X, will be required in the next 3 years, year 1, year 2, year 3. At the end of each year, this company must pay interest. Must pay interest there. Remember, unless told otherwise, interest is always payable at the end of the year. So at the end of year 1, this company must pay interest. At the end of year 2, it must pay interest. At the end of year 3, it will pay interest. And also here in year 3, our company still will have to pay the principal amount. So therefore, to determine the liability component, we discount all this. What is to discount? To discount, by now, I hope you know, is to get the present value of future cash flows. So therefore, in terms of how we determine this, we add 2 items: present value of annual interest. Annual interest is this interest which is paid every year. And I also hope you know from financial management is that topic of time value of money. Such interest which is payable annually is known as annuity. Annuity is a series of payments. Payments. Sherin, you need to mute yourself. Or do you have a question? Sherin. Okay, so therefore, we get the present value of annual interest plus present value of principal amount. Principal amount is now this amount which will be payable at the end of the life of such convertible debenture. So this amount, because is a single amount which is payable at the end of the life, or basically at the end of the 3rd year, is a lump sum. It's not an annuity. And basically, I hope you know how to discount an annuity, how to discount a lump sum or a single amount. So therefore, we discount those two amounts, the annual interest and also the principal amount, and then we add that. Whatever you get is now the liability component on the date of the issue. On the date of the issue of that what? A compound financial instrument. So once we have done that, we have computed the liability component. And remember, we are looking on the steps, because what we have said is that International Accounting Standard number 32 requires that anytime the company has issued a compound financial instrument, the company should split the 2 components, the liability component and equity component. Which steps are followed to do that split? One, we have said always you have to compute the liability component by adding 2 items: present value of annual interest and present value of the principal amount. Once we have computed that liability component, step number 2 entails computation. Compute the equity component. Compute the equity component. So how do we compute this equity component? This is quite simple. So we take the total proceeds. The total proceeds is what? Total proceeds, this is the total amount now which was received by the company after issuing. This is the amount received by the company after issuing those compound financial instruments. So the total proceeds, in other terms, is the total amount received. Total amount received by the company as a result of issuing this compound financial instrument. If the company issued convertible debentures, automatically there is that cash the company received. So we take that total proceeds, and then to this what we do is that we less the liability components. We less liability component which was determined in step number 1, as determined in step number 1. So whatever you get there is the difference. Whatever you get there is the difference is now the equity component. Is the equity component. Equity what? A component. So therefore, that's how we split or how we determine the equity component and the liability component. And basically this liability, sorry, not liability, but equity component, this remains the same. It remains constant. If the compound financial instrument issued had a life of 3 years, that value remain unchanged. The equity component remain unchanged. But this liability component, once it has been determined, it must be amortized. It must be amortized. Basically, what you mean by amortizing a liability, it is to write off a liability. I hope maybe equally in FM, you have done something to do with loan amortization schedule. If you acquire a loan today and you agree with the bank that you're going to repay back that loan in the next 3 years, in the next 5 years, so in your books of account, you have to amortize that loan. You have to amortize that. To amortize a loan, first of all, we know a loan is a liability. To amortize a loan is to write off that liability because you're going to clear, or by the end of the 3rd year, by the end of the 5th year, you have cleared the entire loan. You have to amortize it. You have to write it off in your books of account. So therefore, this liability component must be amortized, but equity component, we have said that it remain what? It remain the same. So therefore, those are basically the steps which are followed, the 2 steps which are followed to do what? To split the 2 components, the liability component and also the equity component. So I want us to take a short break and then we come back. We look on a small illustration. If you go to the notes I've shared with you, in the first page, you'll be able to see an illustration which is there. So maybe look on it and then we come back after break, we look on that. So we take a break of 10 minutes. So we meet exactly at 9:20. 9:20. Yes, so the question reads, is this a small illustration here? So it reads, ABC Limited issued 2,000 convertible bonds at the start of the year 2020. The bonds have a 3-year term and are issued at par with a face value of shillings 1,000 per bond, giving a total proceeds of shillings 2 million. Interest is payable annually in arrears at the nominal annual interest rate of 6%. So basically, being told that the interest is payable in arrears, it means that the interest is payable at the end of the year. At the end of the year, I hope in FM you have looked on two types of annuity. So we have the annuity due and the ordinary annuity due and ordinary annuity. So then you're told each both is convertible at any time up to maturity into 250 ordinary shares. When the bonds are issued, the prevailing market interest rate of similar bonds without conversion option was or is 9%. So what we are required from that particular illustration is we do what? We calculate the value of liability and equity component of the convertible bond. So we require to compute the equity and liability component from that particular information. Remember what you have said is that if you come across such a question and you're required to split the 2 components, the equity component and also the liability component, and they are the steps which you follow. One, we have said you need to compute what? You need to compute the liability component, and then from there you proceed and you compute what? The equity component. So therefore, those are the steps which you are going to follow. And the step number 1 here is to compute the liability component. We start by computing the liability component. How do we compute this liability component? We have said that we compute this by adding 2 items. By adding 2 items, 1, we take the present value of annual interest of annual interest plus the present value of the principal amount of the principal amount, principal amount, present value of a present value of a principal amount. So those are the two items which we need to add. So therefore, the first thing we need to do is to determine the annual interest. This is the interest to be paid annually. And then from there, we determine the principal amount. The principal amount. So the annual interest, maybe going back to that particular question, I hope you already have the question with you. I hope you already have the question with you. So what are we told? We are told that this company issued 2,000 convertible bonds, which do have a face value of 1,000. So essentially, what that means that the total value of those particular debentures which were issued by this company were 2,000, because these are the number of bonds times the value, which is 1,000. And in this case, we are told that the interest which is to be paid by this company is at the rate of 6% per annum. So therefore, this is the interest per annum. This is the interest per annum, the interest to be paid per annum. I think we can put it well here. So what we are determining is the annual interest, which you are saying will be equal to the bonds issued 2,000 times 1,000 times what? The rate there, which is given as what? 6%. 6%. So this now will give us the interest per annum. So give me that figure there. Give me that figure there. Give me this figure there. So I'm waiting for the figures here so that we proceed. So give me the answer, you give me the answer so that we move. Yes, I'm waiting for the answers. I'm waiting for the answer. Give me the answer. Give me the answer, Kaidri. Okay.
120.
Yes, just type the answer there, Abdul. So how much is this? We're getting one. Okay. 120,000, or what is it? Okay, 2,000 times 1,000 times 0.6%. Yes, so that will give us shillings 120,000. 120,000. And remember, this is the interest per annum. It is the interest per annum. Interest per annum. So therefore, this company will be required to pay interest of how much? 120. And then from there, we already have therefore the annual interest. Then next, we need to determine the principal amount. The principal amount. What is the principal amount in this case? The principal amount, we have said, is the amount which is supposed to be paid at the end of the life of those compound financial instrument. If you go back to the information which you're given in that particular question there, the information which you're given in that question, you'll be able to see that these convertible bonds which were issued, I hope you can see there is somewhere we are told there, they have a term of 3 years, a term of 3 years. It means that this company will pay this interest for the next 3 years. And then we also need to determine what will be the principal amount. The principal amount. Now, the principal amount in this case, unless told otherwise, this is always equal to the par value. The par value is the same with the face value, and also the same with the nominal value, and also the same with the nominal value. So therefore, that is the amount which is to be paid at the end of the 3rd year. And remember, in our case, we are told that this company had issued 2,000 convertible bonds, and they have a face value. Face value, I've said, is the same with the par value, is the same with the nominal value. So meaning that at the end of the 3rd year, our company here will pay back an amount of how much? 2 million. 2 million. Maybe for you to be able to understand what we mean here is that this company issued convertible bonds which have a life of 3 years, or a term of 3 years. Basically, what that means is that this company, this is the start of year 1. In financial management, you refer to that as time 0. I hope that is something we have done. So at the end of year 1, this company will pay an interest of how much? 120. It will in year 2 an interest of 120, and also there an interest of 120. And also at the end of the 3rd year here, other than the company paying interest, it will also be required to pay back this principal amount of how much? Of 2,000. So therefore, for us now to get this liability component, we have said we need to discount this interest, this annual interest, and also the principal amount. And therefore, what you have said is that because in this interest, you can see is payable annually, this, for the purpose of discounting, we refer to this as annuity. And this is an annuity which is payable at the end of the year. At the end of the year, there is a specific word which we use to refer to, or which refer to those annuities at the end. And then this is a single amount which will be paid at the end of the 3rd year, and therefore we refer to that as a lump sum. Yes. So how do we discount? How do we get the present value of annuity? This is something you have done in financial management, in that topic of time value of money, a present value of annuity. So in this case, we take the present value interest factor of annuity, at which rate, in this case, if you go back to that particular question here, there is something we are given almost. Okay, in the last sentence, we are told when the bonds were issued, the prevailing market interest rate for similar bonds without conversion option is 9%. Now that prevailing market interest rate is the rate we use for discounting. So therefore, here, to get the present value of annuity, we take the present value interest factor of annuity, at which rate? At the rate of 9%, and then we multiply that with our annuity. So therefore, we can start by computing this present value of annual interest. So we start by getting present value of annual interest. So our interest, which is now the annuity, we have said is 120,000. So what we need to do is we multiply that with the present value interest factor, at which rate? 9%. So because here we don't have the table, you have now to remember the formula for this. This is something you have done in FM. So how do we compute this, or which formula do we use to get that? So we take 1 minus 1 plus R raised to power negative n, and then we divide that with R. We divide that with what? With R. So that is the formula which we apply here. So therefore, that's what we need to have here. So 1 minus 1 plus R. Remember our R is 9%, so we're going to have 1.09, and then we raise that to N. N in our case is 3 years, because you're told these both are a term of 3 years or a life of 3 years. So our N is 3, and then we divide that with R, which is 0.09. So that's how we compute what? We compute the present value interest factor at the rate of what? 9%. So I think we can quickly do that. How do we compute that? We take 1.09, we raise that to power negative 3. Okay, that will give us around 0.7722. So we have 1 minus that divided by 0.09. So automatically you have to work out that. So, and then from there we get the final figure, 1 minus 0.7722, and then divided by 0.09. So I'm getting around 2.53111, and then you multiply that with 120,000. 120,000. So if I'm not wrong, I'm getting a figure of 303,733. 733. That is what I'm getting. I hope you're also getting the same. So what we have now is the present value of the annual interest. So remember, to get the liability component, we have to compute or to add these two: present value of annual interest plus the present value of the principal amount. Our principal amount, remember, you have said, is how much? Is 2 million. So therefore, we need to get the present value of the principal amount. The principal amount. So the principal amount in our case is 2 million, 2 million, 2 million. And then we need to multiply that with the present value interest factor at the rate of 9%. Remember, this 2 million, this is not an annuity. This is not payable annually. This one will be paid only at the end of that year. So therefore, we multiply that with the present value interest factor of a single amount of a lump sum. And in terms of how we compute that, we take 1 plus R raised to power negative n. Raised to power negative n. So I hope you have covered all this in FM. So therefore, we take 1 plus 0.9 raised to power negative 3. Raised to power negative 3. So that we get the final figure there. So let's work out that. We have 1.09. We raise that to power negative 3 times 2 million. Times 2 million. And that is giving me 1544. 367 to the nearest whole number, 367. So therefore, what is this? It is a present value of the principal amount. So therefore, finally, I think we can now get the liability component by adding these two. So we need to add these two figures there. 303,733 plus what we have here, 1544,367. So we add the two. We add the two. We add the two. 303,733 plus 1444,367. So I'm getting a figure here of 1848,100. That is a figure I'm getting. I don't know whether you have the same, although in our solution or in our handout, we already have that. I don't know whether that's a figure. That's the figure, that is a figure. Yes, so it's coming to the same, although there is a difference of 22 because of rounding off. So therefore, what we have now is the value of the liability component, the value of the liability component. Now, having determined that liability component, that is step number 1. Step number 2, we have said we proceed and we compute what? The equity component. The equity what? component, equity component. So let's do that. We determine the equity component. Equity component. So how do we compute this equity component? Remember, this is now step two. So to compute the equity component, one, we have said we take the total proceeds. The total proceeds. What is the total proceeds? Total proceeds have said that this is the total amount. The total amount which was received by the company after issuing those convertible boats. So we know that the boats which were issued by the company were 2,000 and they had a value of 1,000. So meaning that by the end of the day, this company received a total amount of how much? 2 million. So that is the total proceeds or the total amount received. So we have said we take that, and then to this we less what we have referred to as the liability component. The liability component which we have computed in step number 1. And we have it here, 1848, 1,000, or 100, yes. So that now we get the difference. We get the difference there. We get the difference. So give me the difference there. The difference between the two. Give me the difference. Yes, I'm waiting for that difference between the two figures there. Yes, I'm given a difference there of how much? Of 151. 900. I hope the rest are getting the same. I'm not getting any figures from you. So that difference is now what we refer as the equity. That difference is now what we refer as the equity component. The equity component. Equity what? Components, yes. So basically that's how we split the two components, the liability component and the equity component. I hope you can see what you have done. One, we have said we compute the liability component. How do we compute the liability component? By adding two items. By adding the present value of the annual interest. You have to compute the interest to be paid annually. You discount that, you get the present value. You get the present value. Because that is annual interest is an annuity, I have said you take your annuity multiplied by present value interest factor. Always in such a question will be given two rates. You will be given something called the nominal interest rate, or something known as the coupon rate. Coupon rate, like in a question here, this rate which was given as 6% is the coupon rate. Is the rate which now you use in terms of computing the interest to be paid annually. You'll also be given something called the effective interest rate or the prevailing market interest rate. Now, that effective interest rate or the prevailing market interest rate is what you use as your R here for discounting purpose. So therefore, you should never confuse that. Utapewa rate mbili, the effective interest rate or the prevailing market interest rate and the coupon rate. So what you use for discounting is the effective interest rate. Coupon rate, use it in terms of computing the interest. So you discount that and then compute the present value of the principal amount. Remember, you have said that this is not an annuity. It's a single amount which will be paid at the end of the third year. So therefore, this is how you compute now the present value interest factor using that formula there, 1 plus R raised to power negative n. So then you add the two present value of annual interest plus present value of principal amount, you get now the liability component. Then from there you proceed to step 2, you compute the equity what? Component by taking the total proceeds or the total cash received minus the liability what component. So the difference is now what we refer as the equity component. So therefore, that's essentially how we do the split, or what was required in that particular question there. That what was required there. So therefore, what we'll do in the same handout I've shared with you, that handout having bearing the notes. In that still page number 1, there is illustration 2, another illustration there. So what you do that illustration as an assignment. That you just name it as illustration 2. Illustration 2, you do it as an assignment. You do it as an assignment, And once we meet now in our next class, I think we shall look on the classification, because what is remaining is something small now. Already we have the background of this topic. So we shall look on the classification of financial asset. Remember, you have defined what a financial asset is. You have said that this is investment in shares or investment in debt instrument. We shall look on the classification of a financial asset, how financial assets are classified by our standard here, IFRS 9, and also how we initially recognize each category of financial asset and a subsequent measurement. And then from there, we shall also look on the classification of financial liabilities, and also the initial recognition and subsequent measurement of the various categories of financial liabilities. Yes. So therefore, that I think what is remaining, and that is something now we will be able to finish in our next class. So therefore, for today, unless maybe there is a question, I want us to stop at that point. Any question? Any question on what you have covered? Any question? So I think if none, we stop at that point. You have a good night. We meet all. See you in our next class on Sunday. So have a good night.